Okay, gentlemen, welcome to our presentation of the audited accounts and the performance of the company for the period ending 31st December 2023. I see Mr. Mukesh Kothari and the Vision Investment, maybe Mr. Bas. Welcome to both of you. And we will take briefly the introduction to the company, which I think we're all very familiar. Go to the next thing. I think this is what we have for you today, introduction and the rest of the statement. And finally, we'll come quickly to the question and answer session. And before that, let's proceed with the introduction. So as you're all well aware, I think we are incorporated in January 1997, and that makes us probably 26th or 26th year of operations, right? And we started with the 3 million capital. 60% was contributed by the founders, including Bank Muscat, and 40% was offered to public in 1997. And we had a bit of history in making. 43 times our issue was oversubscribed. And alhamdulillah, today our net worth stands about approximately 70 million. We have a very illustrious, experienced, and far-sighted board headed by Sheikh Khalid Al-Wahibi, and we have his deputy Sheikh Khalid Mustail Al-Mashni, who also is a chairman of large banks and other investment companies, very experienced. And we have Mr. Abdul Razak and Sheikh Zaki Hassan, who's also chairman of the audit committee. And with the oversightiness of the board and their guidance, the company has been able to operate in a very efficient and optimum manner, bringing value to all the stakeholders. As you will be aware, the term of the board members ended on 31st March 2024. Since then, elections have been held, and we have two new members, Sheikh Awad in place of Mr. Abdul Razak, and we have Mr. Nabil in place of Mr. Ketan Wasa from the ministries. We would like to place on record our gratitude to Mr. Abdul Razak as well as Mr. Ketan Wasa, who have, especially Mr. Abdul Razak, who has guided the company since very inception. He was an extremely well-regarded figure in the financial services business, and he offered his advice and counsel anytime the management needed. And we remain grateful for having guided us for so long, and we wish you all the best. Similarly, we would like to thank Mr. Ketan Dinakar Wasa, who has been with us for the 3 terms and whose experience and counsel was very valuable, both in the audit committee as well as in the board. Thank you, Mr. Wasa. And we would also like to welcome 2 new members. As I already taken the name, they're very well experienced and very far-sighted, and we hope that we will certainly benefit from their expertise. As you're aware, we have a team of about 155 employees. Our resources, they are our main resources. They are the bread and who contribute towards the well-being and the profitability and the services of the company. We have an experienced management team. Alhamdulillah, we have a combined management experience of a large number of years. You have Mr. Salim Awadi, our Deputy CEO, who is very well experienced. He's also on the boards of many other public companies. We have Mr. Break Musallam Al-Amri, who is also very well experienced and chairman of the very large public companies. And we have Lata Ramakrishnan, who has been with the company for more than 25 years now and provides a tremendous amount of her expertise in risk management as well as in the other aspects of the company. She headed the finance earlier, coordinated the IT systems. We have our CFO, Mr. S. Chandrasekhar, who has been with the company also for about 25 years, who plays a stellar role in management of the treasury, compliance, and other related functions. We have Sami Al-Hasni, our HR manager and also in charge of the investor relationships, who has been with the company for long and who is very well experienced. We have our head of the corporate here, Mr. Viju Varghese, who has again been with the company for a long time. We have our IT team here and the head of the consumer loans division. I would like to welcome all of you. And we'll now move on to the next. You're well aware about our products. You know, we are continuing with the products that we had launched, which both on the corporate side, we have a bouquet of products which meets every aspect of corporate requirements. We have retail, two basic products. One is the asset loans for car, commercial and personal vehicles, as well as we have the loans, hire purchase loans for acquiring consumer durables, which are branded as the lifestyle loans. We are also studying the process of looking at the new licenses that Central Bank of Oman has granted, basically the personal loans, as well as the loans for developers of real estate. These two are under consideration, and we are working on this, inshallah. Once we make some progress, we'll keep the market, all of you informed. And what makes Elomania, you know, your valued partner for all our customers, our corporate customers, retail customers. Our customers probably now run into hundreds of thousands over the last 26 years. You know, the large corporates, blue chip companies, family businesses, ultra high net worth individuals all have found value in Elomania. They all transact with us, and we value them as our partners. And we are very happy that we have been able to provide uninterrupted services. We had no opportunity to either reduce or withdraw from the market at any point in time. Alhamdulillah, gentlemen, very, very proud of our dividend policy. Our board of directors has been very far-sighted. They believe in consistency and they believe in sustainability. As a result of these policies, we have been successful in paying dividend every single year of our existence, which is a track record that we are very proud of. And this is a very unique track record, which I think very few public corporations have been able to achieve. Gentlemen, we have so far paid close to 500%, almost 500% dividend since inception of the company. Both a majority of it cash as well as partly in security. We also have been extremely innovative in our dividend. We were the first to introduce convertible bonds as part of the dividends. That was also a history in making in terms of innovation. We also have the very first company in Oman to issue convertible bonds as dividend, which we have already done twice, including for the year 2023, which is going being paid out.
Aftab, can I just interrupt? I think we have you know, in the background, Mr. Pratik. Now he closed his microphone. It's okay.
Okay. Thank you, Salim. Can you move on to the next? Now, briefly here, you know, we don't want to get into this. Is also already the public information in public domain. You are well aware of the details of this. What we want to really say is that after continuously running deficits from 2016 onwards and low oil prices, increased borrowing, we have now got out of that situation. Our fiscal health has tremendously improved. We are back into being a surplus budget country. Our debt has come down well within the limits. Our ratings have improved. Oil prices have improved. Spending on infrastructure and public spending has gone up. especially this year, almost close to about 600 million has been allocated for social spending, which will increase the domestic as well as the spend. We believe that this will have a spur on the retail spending and increase the cash flow availability. We also seen the surplus and deficits here, and I think we are now very well positioned. 2025 with Vision 2020 coming in, the government of Oman has envisaged a growth prospect in all sectors of the economy. The efforts to continue to become less dependent on the oil are continuing, and I think with the ratings in place, we hope that 2024 and 25 onwards will be a landmark years. The expected GDP growth is also going to be higher than the average GDP of the what IMF has predicted for the whole world. So I think with continuous oil prices being stable, deficit down, social and infrastructure spending up, we believe that we are well poised for growth. Alumani is extremely well capitalized. We have resources. We are sitting on a large amount of cash flow, which has been deployed profitably. So we are in a position now to take care of the what you call the new economic opportunities that are there. Here, gentlemen, is a brief here about the deficit from 2016 to 2021. And you can see that 2022 onwards, we had a surplus budget of more than $1 billion. Go to the next. Yes, I already touched upon this. Yeah, this is the debt to GDP ratio that you can very well see that the total GDP, debt to GDP went up to high of 61.3%, 69% in 2020. That was the peak. We had a low of 4.93% in 2014. And now 2000 estimated is going to be 35% in 2023. I think it's well within the range. The policy, the regulators and the rating agencies have looked at it very favorably. And now our ratings are improved, and we hope that we'll get back into the investment grade in the next quarter. One point we'd like to touch here, gentlemen, has been the increase in interest rate, which as you're well aware, what's happening in the world markets, especially United States. The Federal has not indicated any decrease. We're expecting some respite in the second quarter of this year, but that's very unlikely to happen. We believe that somewhere around third or fourth quarter, we might see 25, 50 basis point reduction, but that will get factored into the profitability only in the year 2025 beginning. I will still have to remain with the high interest cost for the current year, 2024. But I think we as an institution are well poised. We have mitigated most of those by having a large liquidity reserves. Both the liquidity reserves are high, and as a result of which they reflect in our cost of borrowing, which is, in our opinion, and if you can see the comparative statements, about 150 to 250 basis points, we are lower. Now let's look at the last 5 years performance of the company. This information is in public domain. I'm sure all of you have seen this information. Our revenue stream has been very steady in spite of the downturn that we saw from 2016 onwards. Then we had the double whammy of the COVID, but thanks to the oversight and from our board, as well as the guidance and the management team that we have been managed to tide over those crises profitably. We haven't skipped dividend in those years, nor we had any opportunity to have any liquidity crisis. So if you look at our revenue has by and large been steady. We have gone on to a growth path again in the 2023, where we saw growth in the revenue. As you can see, the interest cost has gone up from 22 to 2023. However, the net income has also been up in 2023. Operating expenses were marginally up by about 300,000. As a result of which, you can see our provisioning has still been very robust. We continue to hold robust provisioning. I will come back to the provisioning policy in a minute. However, if you look at our profitability, we have been on a growth path since 2020, and I think we hope that 2024 will also be a better year. Our assets also have grown. We believe in, we have having a very quality book. Yes, we continue to be conservative because the cost of bad risk is very high. Our debt equity ratio is very, very conservative. Our ability to borrow is very high. We're already sitting on a large reserves of liquidity. And as and when the opportunities arise, as we see the GDP growth, as we see the green shoots emerging, the company will be in a position to benefit from those opportunities. And compared to last year, our dividend has been marginally higher by 1%. And we have come back to you with the non-convertible bonds as dividend. And that is augurs well for the shareholders and is also well for the company because it does not put pressure on the paid up equity capital. And now here is a brief on the exact comparison between 2022 and 2023. Our revenue is up by 29%. Then the finance income was up by 9%. And the total income was up by a good 23%. And interest expense has been up, both because of the increase in the asset size, as well as increase in the cost of borrowing. Therefore, our net income grew by about 14%. There was a fall in the other income, basically because of the right of collections and the other fees. Operating expenses are up by 7%. Provisioning was a good at 2 million, marginally lower than last year. And as a result of which, our net profit before tax grew to 3.7 million, an increase of 16.03%. Income tax provision was higher naturally at 553K, and net profit after tax grew from 2.7 million to 3,200,000, which is a growth of 16.42%. As you can see, the structure of our balance sheet, there has been a slight increase in the cash and bank balances of about 5 million. Deposit with central bank remains constant at 250,000 as per the regulatory policy. And the net investment in the financial leases has gone up from 119 million to 127 million, which is a growth of about 6.67%. The total assets grew from 206 million to 220 million, which is a growth of 6.8%. As you see, due to the increased cost of borrowing, especially the spreads on the diminished on the long-term borrowing, and as a result of which we have moved substantially from long-term into short-term. Short-term loans have gone up simultaneously, but they are well mitigated because we hold deposits against this borrowing, as a result of which we do not have any adverse risk of mismatch. So it's not that we really borrow short and lend long. No, we have mitigated that risk very well by a strategy to manage those risks, and they're well within the control. And the last 20 years, we had no problems with the mismatch whatsoever. Term loans, which are basically long-term in nature, have reduced. And we have moved into the short term, as I said earlier, as a result which we wanted to match and keep our borrowing cost as low as possible. Compulsory convertible bond, no major change there. Non-convertible bonds is what was issued as dividend the year 2022. Other liabilities are almost constant. The total liabilities grew from 140 million to about 153.8 million, which is a growth of about 9.8%. The equity capital, there's a marginal growth that was because of the conversion of the bonds issued earlier, 5 years ago, which got converted into equity shares. This equity shares were issued at a zero price to the shareholders. They were as part of the dividend. Share premium on that went up. So we have almost $1 million in share premium now. Legal reserve is 10.2 million. No further legal reserve is required. We continue to have about 5 million of special reserves for non-performing assets as an additional cushion as a matter of abundant precaution that the company has created. Our retained earnings are about 20 million, and as a result of which the total equity is 66.78 million. And the total liabilities and asset size was 220 million. Therefore, the book value of the share stands at 217% of that, or 217 paisa on a par value of 100 paisa shares. Gentlemen, this is just to show you the comparative. This is based on the published figures, and this is very clear for you to see. This is from the published balance sheets in the public domain. Our provision for bad and doubtful debts is 18 million, and you can see what the provisions are there. And the most important point here is that what is the provision cover? Non-performing loan coverage. We have our coverage stands at 503%. Which is the highest provision cover in the banking and the non-banking space. And you can see the peers stand at 81%, 83%, 71%, and 73%. Our net NPLs are negative. That means by 3.5%. That means we don't have any uncovered non-performing loan whatsoever. You can see what is there for the peer analysis. We don't like to comment on that, and you can draw your own conclusions about what Aluminum has on offer for our stakeholders. Now, this is a historical review of Aluminum starting in 1997 when we first went public. And you see in 1997, we had a capital of 3 million. And there was a rights issue in 2000 to meet the regulatory requirement of make the capital 5 million. Thereafter, we have made capital issues, both rights issues of shares as well as bonds, to meet the growing requirements of the company. And therefore, we came up with the issues in 2004, 2008, 2007, 2010, and 2012. And this is what the Aluminum has paid to stakeholders. Cash dividend paid till 2023 was 387%. Stock shares was 27%. Non-convertible bonds 10. Stock convertible bonds 67. Total dividend paid was 491.873%. Net worth is 30 million. As you can see now, the net worth stands at about 66.8 million.
Post-dividend.
Yeah, convertible bond yet to be converted is 4 million. And the total of the capital and retained earning legal reserve is 62 million. Total 66.8. No dividend for the year 2003 declared and to be paid after March 2024. AGM is also included. This includes the year dividend for year 2023. So this is our track record, which speaks hallmark of consistency, sustainability, and And that's, I think, the philosophy that our board of directors believe in. We, the management, have laid out a very clear strategy, how much and would like to grow. Our primary concern has been to maintain the dividend payouts for the shareholders, and we would try our best that to maintain a record of continuous payment of dividend since inception of the company. Now, what the future holds for the company? Now, yes, I think we have a lot of comments coming in the past about the why how much the company has grown. We believe that 2024 will be a relatively better year for the company. We are beginning to see more spending. We are beginning to see consistency in the oil prices. So I think we will be, and at any point in time, gentlemen, we would like to assure you that we will grow not at the cost of having to ride a subprime or lower quality business. We do compete with the largest lending organizations in the country, which is basically the banks. Banks continue to be our primary competitors, and we do have a lot of structural issues as an NBFC when we compete with the banks, but we have resolved those issues. We have built a solid reputation. Our cost of funds is lower. Our service levels are good. We are quick and fast, and as a result of which, we still continue to attract blue chip companies, family businesses, large government, the public limited companies, etc. So, and we'll continue to work with that. We'll also continue to work with the banks on this, participating in the syndications. We are working on a couple of them now, and if anything comes by, we'll keep the market informed. We are very proud of this achievement. And both for the year 2022 and 2023, in a very independent survey, a survey voted by the people of Oman, we have been overwhelmingly voted as Oman's most trusted non-banking financial institution for the year 2022 and 2023. We understand from the that Alumania was voted by a very, very large majority as the #1 brand in the non-banking financial services business category. We're indeed proud of this record, and we hope that we'll continue to stand by standards that we have set for ourselves. Gentlemen, we come to the end of the session, and if any of you have the questions, we'd appreciate if you please announce your name, the organization that you represent, and the question that you have. Thank you very much. We would like to welcome all the participants here. Please go ahead. Mr. Abbas, Mr. Joyce Matthew, Mr. Manna Thomas. Then we have Mr. Kothari. Abbas, I think you should take the lead as usual. Please go ahead.
Good afternoon, Mr. Aftab. Thank you very much for the call and a very informative presentation. Thank you for that. I was following your comments quite closely about how optimistic Oman's financial future seems to be. We're coming up on the back of 2 solid years of oil prices. Can you comment in this scenario? I mean, I know we've had many such chats in the past, and you've always said that you want to grow, but not at the cost of high-end players. It has to be profitable growth. So now that we're coming off 2 years of solid economy, and we seem to be out of the COVID troubles, I think Alumania starts looking interesting on 2 fronts to me, and I just wanted your comment on that. One is, of course, on the growth side, and secondly, on the recovery side. It's no secret that you keep this 500% provisioning, by far the highest in the sector. So naturally, the risk cycle will come down where your recoveries will go up and your provisioning cycle should come down as the economy improves. Is that how it's supposed to play out? Because if that happens, you're looking at a substantial operating profit growth going forward. Or is it not as simple as that, and there's some other sort of dynamic in the mix that maybe I'm missing? That's my first question.
Sure. On the growth side, as you said, we are beginning to see, and I think the IMF predictions are that we'll have a growth rate higher than the average rate what they have set for the world economy as a whole. And we also have seen that there has been a spurt in the public spending. We have seen the investment coming out in the real estate projects here, and we've seen some very, very investment intensive projects which have been launched now. Also, the liquidity is beginning to improve. We don't see the same crisis that we had seen earlier, especially during the COVID times. That's now what our current, our phones ring much less now. Customers asking for postponement of the debt or reschedule and restructuring. Those queries are certainly coming down. From our experience, we can vouch for that. But what we believe is that our growth strategy would be to grow much higher than the average Oman's economic growth, which we will try to beat that growth factors. And we will also continue to focus on those areas. Currently, our focus is oil and gas, because that we find that the liquidity is one of the highest. And also the the default rates are probably one of the lowest in this sector. The equipment side of the business, the equipment rental side or the equipment leasing side of the business is just about beginning to pick up. We saw a lot of supply constraints even up to the first quarter of this year. In the capital goods side, there was a lot of supply constraints and availability of capital goods of all types, whether it is cars or equipment, anything, was a bit of a question mark because the supply was, constraints were there, which that is beginning to improve now. You don't have to wait too long to get the assets that you desire. And therefore, hoping that these constraints are sorted out, we'll see a better inflow of business coming in. However, a word of caution here, Abbas, that we're all expecting that the interest rate would probably come down. The Fed would, we're hoping against home that at least by end of first quarter, you would see some kind of indication or at least a 25 basis points cut. And we saw no such thing. And in fact, Fed has continued to say that they're not making any promises. The data that came out just 2 days ago looked slightly better, and Fed had mellowed down its position. So therefore, I think that you can probably see if you're lucky by end of second quarter, or maybe by 3rd September, that is, you can see some reduction. We hope that does happen. Currently, we're all going through the high interest cost cycle, which is reducing our margins, putting pressure on the clients, right? And also becomes a cause of a bit of inflation that you see. So I think, but the thing is that any reduction that probably may come into third or the fourth quarter, end of fourth quarter, you will see that factored into the profitability only in 2025. So that is an issue that we have to take into account. The borrowing in dollar continues to be at a much higher cost. We are lucky that relatively speaking, the Riyal Omani liquidity is much better than the dollar liquidity here. The cost of borrowing Riyal Omani is marginally lower, at least 25 to 50 basis points lower. And thanks to our own liquidity reserves that we maintain and we deploy it very profitably, we have managed to reduce the cost of borrowing to almost about 150 basis points and also avoid the mismatches. Especially a lot of companies, including Alumania, have moved from long-term into short-term that I explained in the presentation when I showed you the balance sheet. Almost 60 million Omani Riyals we have moved out of long-term into short-term. However, in our case, there is 100% mitigation. We don't have any mismatch issues here or risk related to mismatch. So having said that, yes, growth, we'll see some growth coming in. However, that will be constrained by the interest rates that we see. Now, coming down to your provisioning policy. Yes, we continue to maintain the provisioning policy. What we call, Abbas, what we have defined is that we call it the virtual cycle of provisions. Now, if you look at closely at our balance sheet and the notes that are there, if you see a substantial amount of our provisions actually come from the collections bit. So on a net basis, the provisions are lower. Number one. Two, if the high provisioning is there is a contingency that we need to have at all times, right? Now, unless there is an upsurge and some large corporate accounts do we manage to collect them, yes, there can be a what you call a windfall coming in, but we would like to predict that. Secondly, in the lending business, there are uncertainties. One corporate gets collected, then you suddenly find that some large corporate is beginning to struggle. The history of some of the large corporates is there right in front of you. I don't want to take the names here. You know, in the last couple of years, many of them have now gone through restructuring. They have gone through rescheduling. They have gone through debt mitigation. The security cover has come down. And I can tell you that the regulators have now mandated a certain amount of compulsory provision on those assets. Fortunately, we are covered. So what I can assure you is that we don't expect to be hit by any large corporate going into some kind of distress. That is the assurance that you have. But whether we will benefit and how much we will benefit from the windfall is something that I wouldn't like to take a guess or make a conjecture.
Thank you for that. No, thank you. That, as usual, a very well-rounded and informative answer. You know, we expect nothing less from you. So thank you for that. Yeah, you know, my two bits was that this virtual cycle of provisioning has obviously helped you with a 12% market share, borrowing even cheaper than a guy with a 45% market share. So I see the benefit of it. It's just that, you know, as minority investors, you know, who have not been with you from the inception of the company, right? People like us have only started investing over the last 2-3 years. You obviously want shareholder value. Now, one part of it is you are sitting on this 500% provisioning. And if I'm thinking that the economy picks up, how much is too much? You know, that's the question. I mean, I completely give kudos to you and your team. I mean, no man can do this alone to sort of, you know, hold on to your, you know, your firm beliefs and, you know, create value for shareholders over this long period of time, which is very challenging in a sector like you, where NPLs are 10-15% of what you write. So, I mean, it's not lost on me. But, you know, for me and for any other minority investor, we have to look forward, right? So where do we get value from? The value can come from organic growth, or if there's any inorganic opportunity in the form of a merger or an acquisition. So, you know, that's the reason a lot of my questions tend to focus on, is there more organic growth coming our way, especially because you've sort of gone through the worst of the economic cycle in Oman and you've emerged unscathed. And, you know, that's why I always try and focus on where the organic and inorganic growth for shareholders can come. So if you can comment on the inorganic side, sir, I'll appreciate it. If there's any initiative, merger, acquisition possibility.
Sure. Abbas, thank you very much. You see, what we saw is that now we expect some windfall and growth to come from the organic growth. Certainly, as I said, the economy is beginning to grow and our balance sheet has grown marginally. We are very actively looking to grow our book, by the way, without substantially compromising on the asset quality. See, when the liquidity improves, when the optimism improves, you know, overall, then what happens is that our ability to target and write a little more business also improves, right? We cannot be entering into segments which are already struggling. I expect the equipment rental side of the business to go up. We've also seen some of the large infrastructure companies, big contracts being awarded. They're back into having $500 million to $750 million in order books. Some of the older companies which were very active are unfortunately in liquidation now. And the new players are beginning to emerge. They will take some time. What we can say certainly is that if you look at our dividend payout, like, you know, for example, 2023 was about 13%. And, you know, we are the first and the only company where the regulators have approved a non-convertible bond as a dividend, right? So that ultimately acts as a deferred cash dividend. So even if you look at our average price, which is about 1.6, if you divide it by 13.25%, you probably have a 9% yield, if I'm not mistaken, 8.5, 9, around that, which I think, and the upside probably may come, we are always open to any positive, any positive market moves are there. We have said that we have large capital. We're very happy to look at any inorganic growth. We're happy to look at any of our players who would like to collaborate with us, with our shareholders. And we would be more than happy and delighted to create greater value. Our ultimate objective is to maximize the shareholder value. That is our very primary objective. And also we say that a company is more than the shareholders. So we also have all of the stakeholders, and we would like to create a win-win business model for everybody. What I'm saying is that, yes, everything is on the cards. We are not saying no to anything, right? If there is value somewhere, somebody is interested, we will look at it in a very positive way. I'm sure our board of directors and shareholders would look at it in a very positive way. We have not said this is, there's nothing which is untouchable for us. We have an open mind and we look at everything.
Thank you, Mr. Patel. I have a few more questions, but let me give my other colleagues an opportunity to interact with you. I'll wait in queue. Thank you.
Certainly. Thank you, Abbas. Go ahead, Mr. Joyce.
Thank you, Mr. Sharath. Thank you for the presentation.
Go ahead.
Just a follow-up on what you just finished talking about. When you said you are open for consolidation, what kind of a role would you be interested in taking up? Will it be that of a consolidator, or will you be looking as a target? Will you be looking at as a target company?
What we're saying, Joyce, is that there is nothing on the table right now. It's not that we are having something. No. What I'm saying is that we are open to everything, right? There may be a possibility that some of the institutions would like to collaborate with us and maybe then end up becoming a larger company. If we see value, merely the size is not equal to profitability or better management, right? There are certain structural issues in consolidation in our geography here, because we all have to work with, what happens when you consolidate, you rationalize. When you rationalize, you eliminate duplication of services, right? So, which is very difficult task, given the task here that we will not be in a position to completely rationalize here, because in that case, what happens, it does not bring a tremendous amount of value. Also, we are not at a stage in Alomania where we are lacking capital. Our debt equity is less than 1. That means we almost have the ability to borrow another 250 to 300 million, right? Which means that there is tremendous possibility for us to grow in a very organic manner. However, as I said, that we don't know at this point, we don't want to, do any guesswork. What kind of opportunities might be available on the table, what kind of opportunities the markets might throw up, whether we are certainly very open to buying out the assets and liabilities of anybody who's interested in a consolidation with us. That looks like the way to go forward, but that's a difficult proposition. For example, we have enough cash. We don't even need to borrow if we had to acquire some of the assets and the liabilities. So that is an area that we are certainly look forward with a lot of optimism, but I don't know whether it is really workable. If anybody is coming up with a proposal, we're very happy to look at it.
Got it.
I hope that answers your question, Mr. Matthew.
Perfectly. Thank you
very much. Go ahead with the next question.
And I've been watching Alomania for a very long period of time, and you've gone through different cycles, and always you have been one of the leader in the market. But recently, what I'm seeing is this is not the old Alomania that we used to see. And this year, you're saying that there is green shoots of growth. We are seeing improvement in banking assets and and leasing assets also has grown by more than 100 million reals. But we are not seeing
NPL slide. Yeah, go ahead.
But we are not seeing Alomania at the center of growth, which which was the case in the past. So when I understand your concern that you are looking at quality of assets and quality growth, but when do you think that we should start seeing this quality growth coming in? We are coming out of COVID.
We are as much concerned, and we are on top of this particular issue. We are, it's there on our minds that yes, we have to take the center stage. Like I said, that getting to the center stage can come from either inorganic growth or through organic growth. Right? Now, inorganic growth, we have all our cards open. We're happy to look at any proposition. Obviously, I don't have to say that some of our counterparts are not performing as well as they should, right? And many of them have what you call unsteady or dividend history, or so there are possibilities that we could look at. However, as you know, that rationalization is the key. If you just add 2 plus 2 on expenses as well as revenue, then what value are we bringing? So we would focus more on the on the organic growth. We are seized of the matter, right? Now let me just put to you another proposition, Mr. Matthew. I want to look at it. I want you to look at it from another point of view. First thing, you can see the slide here. What kind of coverage some of these companies have. I don't want to be in a situation where I don't even have 100% cover on my provisions. And this year, that dividend proposed by the companies was not approved by the regulators. Number one. I agree with that, we haven't grown. But what about the shareholders? We have paid 13.25% dividend this year, which is the second highest in the banking and the non-banking space. So do you want a growth and a lower dividend? Because you see, the moment we acquire assets which need provisioning, the cost of provisioning is huge. If you lend 100 reals, you probably make a net profit if you're lucky of 1 real. But if it's a bad loan, you have to provide 100. That means it takes the profit of 100 deals, 100 loans. So you've got to be extremely careful. Now, what would you like to say when I put to you that how is Alomania in a position to pay the second highest dividend in the financial services business in the country? Now, that is a win-win model. What happens is, you cannot have too much of the very good thing. You need to start coming down, and the cost then goes up. If you see, you go back to some of the earlier years, you have seen that Alomania was growing at very high, 20-25%, and we will pick up on the growth rhythm, but we have not compromised on the dividend. If I am 400 million in size and give you 8% dividend, what is preferable to you? Do you want to have 8%, 7%, or 3%, or 0% in some cases? That is also an important factor, isn't it? At the end of the day, the shareholders also have to be rewarded. Would you like to see, we are a $500 million real company. What are we doing? So we are going to take a holistic approach to the stakeholder rewards. We are going to look at sustainability. We are going to look at consistency. And we will not give up the opportunities when they're available for growth. As I said, growth for the sake of growth is easy. In the lending business, you start lending, there will be no 24/7 the business can run. There will be no end to the queue if you just merely close your eyes and lend. So we have to lend what we call as within the box and not outside the box. We draw the parameters of what we want to lend, right? I call here in the lending business, you need to have inside the box thinking, not outside the box thinking. So that is going to be our primary concern. What we would really assure you and focus on is that will we maintain the payout of the dividend? Yes. We will maintain the consistency in our earnings for the shareholders? Yes. That is what is going to be our primary focus, but we will not give up on the growth opportunities. we will take whatever comes our way in terms of consolidation if it is profitable for the shareholders.
Thank you. I understand that, but just as a comment,
Go ahead.
if we look at the long-term shareholder wealth creation concept, there should be a balance between growth as well as dividend. Yes, you are a terrific dividend payer, but at the same time, that used to come at with both growth and dividend. But recently, my comment is I'm not seeing the growth part coming in. So that's the reason why.
2023, I think we have seen some growth. Our actually income has grown by about 27-28%. Net profit growth has been about 16%. Assets have just been grown about under 10%. What we are saying is that there are several equations to lending. One thing is the sheer amount of capital that you lend, the money that you lend, and at the cost which you acquire that resources. We also focus a lot on the cost. Now, if you see, I'm sure you're aware that a lot of my colleagues are issuing bonds. The coupon itself is about 7.5, 7.75. And if you look at the total cost is in excess of 8%. So if you're borrowing at 8%, 8.5%, at what price will you lend? The day you go into subprime lending is a vicious cycle. It's impossible to extract yourself out of subprime. You lend subprime, your NPLs go up, your cost of borrowing go up. When your cost of borrowing go up, you have to lend at even higher rate, so you go more subprime. We have seen the history of institutions. What we will do is we will lend in a conservative manner, and we are what you call we want to grow. And we have a policy that we will certainly grow and we will maintain. Now, for example, would you like to see a situation? What you're really saying is that let's have Alumania, but let's double what Alumania quality we have. It's like you have one very good cake, lovely, and you want another one. The marginal utility of the second and third begins to decrease. What we are doing is that with whatever business model we have, right, last year also we paid about 12% dividend. This year is 13.25% dividend, right? So I take a point. Growth is important for us. We will not remain static. We will not degrow, right? But we might not grow at the rate of 100%. But certainly we have a strategy that we want to have more organic growth this year. And I take your point, right? And we have noted your point, and we'll look at it certainly.
Okay, sure. Thank you. Another question that I have is on your margins. See, the fourth quarter of this year has seen a sudden decline in margins, in spread, everything. And this is stemming from the fall in interest yield and stable cost of funds. So what has happened during this quarter, and how do you see the margins going forward?
You see, what happened was some of the loans which came up for maturity, historically, you would be surprised that last year, our lowest borrowing cost was about under 4%, right? With your deposit rate is about 5.5%. Alumania lowest cost, 60% of borrowings were under 4 and under 5%. Some of the loans that matured in the fourth quarter had to be renewed at a slightly higher rate. The rate was still lower than our peers. But when you pay 3.74%, from that rate, you go to 5.5 and 6. So almost a 40% increase, right? So that was one of the reasons. Also, we had additional year-end costs that we had to provide. In the first quarter now, we'll publish our results soon. You will see that there has been a reasonable amount of growth again. We have been managed to bring down the cost, reorganize our structure of our borrowings. We have moved substantially from long-term to short-term, almost about 60 million that happened in the fourth quarter. And so we expect that in the next 2-3 quarters, we will back on the growth path.
Yeah, that's on the cost side, right? But your cost also has been between 4.75 to 5%. But my major concern is on the decline of interest yield from 8% in Q3 to 6.5% in
That's
Q4.
an anomaly because there are year-end costs that are there. or, we might have to sometimes suspend interest on some large corporate client as required by the regulators and so on. So you really cannot draw any conclusion based on the one particular quarter. I think that if you wait for a week or so, you will see the first quarter result, and then, you will be able to draw your own conclusions.
Fine. Got it. Okay. That's it from my side. Thank you very much, Mr. Aftab.
Yes. We have Mr. Kothari here. Anybody else? Who's that?
Hello?
Mr. Kothari, would you have any questions? Mr. Pratik is here. Mana Thomas, anybody? Please go ahead.
Hello?
Yes.
Hi, good afternoon. This is Bishan Bhalla from Vision Capital. Thank you for the call and the answers so far. I just wanted to follow up on Joyce's question with regards to cost control initiatives. Now, barring Q4, which you mentioned is an anomaly, in general, are there any cost control initiatives that the company is currently working on?
Currently, of course, we are working on how can we mitigate further the cost of borrowing. The borrowing, the interest is almost about 75% of our cost. So obviously, any savings that we do there impact in a very big way, number one. Number two is that we are trying to talk to some of our large corporate borrowers to see whether we could, increase the rate. But there is a tremendous amount of pressure because we really deal with very, very ultra blue chip companies, So where the constraints are continuing to be there. Barring that, yes, we don't have any substantial plans to hire any more manpower in the current year. So we don't expect any further increase to come in. Last year, we saw some increase because as per the regulatory requirement, we had to move into a 91% localization rate, which we, prior to that, the regulation required about 85%. So we had to do all those adjustments. So we saw some increase in the cost, which has now been spread out, and we don't see those costs repeating in the year to this current year. Thank you.
Mr. Patel, if you'll allow me one last question. I know we
Sure.
are past 3 o'clock. I leave it up to you.
Go ahead.
So, it's been a very interesting and healthy discussion, and kudos to you for being so transparent and very clear in your thinking. So I appreciate that. Sometimes people kind of sidestep these questions, but you've kind of addressed them bang on. So much appreciated. I think it was a very I was listening to Joyce's questions and Bishan's questions and your answers, and I guess you both have made interesting points. From my point of view, there's a third way. You spoke about the need of organic growth and balancing it with a dividend history. And in the last few years, okay, the growth has lagged, but dividend has been consistent. I guess from my point of view, and like you said, forget about share prices, focus on profitability. The cost is important, but what's the end result of the cost, right? At the end of the day, if you're making money. So I guess if you tie everything together, and for me, you're the equivalent of a buying musket in the leasing side,
Thank you. That's a very big compliment of us.
So now when I reflect on Bank Muscat's journey, they've been consistent dividend payers for many years. And then they went through a 2-3 year cycle where they realized they are overcapitalized. They had very high capital adequacy ratio, and they realized they need to create ROE for the shareholders, which is effectively shareholder value maximization. So even a Bank Muscat, and you are far better capitalized on apple to apple. If you look at capital adequacy, you are much higher than Bank Muscat. So I guess the third part here is, if there is no inorganic merger potential, or there is no growth that makes the management comfortable, and you guys are the best fiduciaries we have, right? Because you manage the company through many cycles. Why not consider the third approach where you feel I'm excess capitalized? Even a Bank Muscat has gone ahead and done a capital optimization. I have the cash in the world to do it. Why is that not a possibility? Because I agree with you. Let the markets take care of share prices. But what you can do is take care of ROE. Now, even you will not deny that on the ROE side, Alumani has 4.5%, which is not enough to compensate on a long-term growth for any shareholder, right? Because that's what you're generating in the business. So from that perspective, I propose a third avenue where if you're not comfortable with inorganic growth, which meets your shareholders' requirements, and you're not comfortable with aggressively growing, why not consider a capital optimization, something like Bank Muscat did? And if you need any help from market participants like us, we're very happy to come and sort of advise you on that. Is that something that makes sense to you? Or am I missing something here?
No, Abbas, that's a welcome suggestion from the investor perspective that you have made. And of course, we'll continue that dialogue in private, right? we can have a meeting with our treasury team, and I would be very happy to join in the discussion. Just one point I would like to make here is that, you know that this is the second time that Alumania has come up with a non-convertible bond as a dividend, right? Now, what that really means that in stages, right? I'm not at liberty to disclose what our plans are because they have to be approved by regulators as well as by the board of directors and shareholders. And it's so, but we do have a lot of internal thinking that's going on. Twice we have done now a non-convertible bond. Non-convertible bond is nothing but a kind of a deferred cash dividend on which also you continue to get the interest, right? So we are not increasing the capital too much. We are making sure that rather than have one big cake, we are saying eat a morsel every day. That has been our strategy. But you have a very valid suggestion. I think is that something that needs a lot more introspection and thinking, and we need to do the impact analysis. And I think, Abbas, we will certainly look to you, provide whatever insights that you have, and we look at that certainly. Why not? We're hale and hearty.
Sure. Thank you. Thank you very much for your answers, and all the very best to you and the team.
All right, gentlemen. Thank you very much, and hope we have answered all your questions. Thank you for listening to us patiently and putting up all your answers. Thank you, my team, Mr. Salam, Mr. Brake, Samia, Mr. Viju, Tata, Mr. Chandrasekhar, Prema, Mr. Manish, and Mr. Douglas Chandrasekhar. Thank you very much.
Thank you.